makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Apple is said to face a widening Chinese workplace ban on the iPhone, a sign of growing challenges for the company in its biggest foreign market and global production base. S&P futures extends losses, and the dollar firms after an upbeat service print raises prospects of a Fed hike. Plus, UK Parliament returns after the summer recess. Some children might not be returning to school quite yet as the Prime Minister defends his record on school investment and safety. So let's take a look at the European markets map. A lot going on. We have a stellar show lined up for you. Now, we did have some disappointing data out of Germany, and that's filtering through a lot of these European equities. Now, the DAX currently unchanged. Similar story for the CAC. FTSE a bit of pressure, down 0.1%, as is the FTSE MIB in Italy. Now, a couple of charts that we look at, looking at Fed and some of the expectations that have been going on there. The other thing we look at is, of course, downward pressure on U.S. equity futures, and this is because of the Apple story with China planning to ban a lot of iPhones. So let's get to these two charts that really tell the stories in all its complexity. The first one is the U.S. dollar index. You can see this is what it's been doing year to date, 1,256. We could have used euro yen or dollar yen or actually euro dollar, but this is the one that we've used today, Bloomberg US dollar. The story, it says, is, of course, one of expectations for the U.S. economy. We were expecting no landing, soft landing, no landing, hard landing. And now it seems that it's steady as she goes. The other picture, when you look at a lot of the data coming in from the U.S., is that there has been enough to prompt Fed officials to scale back their estimates for rate cuts in 2024, although we also had a strong set of numbers overall. Now, 2024 looks set to be a little bit less dovish than expected, and you can see this is the Fed Fund futures for 545 there. The other story is, of course, Apple. This is what it's doing in pre-market. This is after China is seeking to broaden its iPhone ban to state firms and agencies. Pre-market, Apple down 1.6%. Now, China plans to, as we were just saying, because of the share price, expand a ban on the use of iPhones in sensitive departments to government-backed agencies and state companies. For more on all of this, we're joined by Bloomberg's Jill Dices. Jill, good morning. I mean, this is a huge deal for Apple. What does it actually mean on the cards?
Yeah, Francine, this is a pretty significant blow to Apple if this goes forward. So as you said, this already covers sensitive departments. So the idea would be expanding this type of ban to some state-backed agencies, SOEs in China. What we've heard is already that some agencies are telling their workers not to bring their iPhones to work. Obviously a concrete ban would go a step further. I mean, look, this is a country where Apple derives something like a fifth of their revenue from China. So despite all of the U.S.-China tensions that have unfolded over the last several years, this is a key market for Apple. Obviously, this is not just a key consumer market, but also a key manufacturing market, even though you've seen Apple diversify some of its supply chains away from China, building, factories in India, that kind of thing. This still remains very, very critical. And I mean, the extent to which a consumer ban like this would actually work. I mean, state-owned enterprises, for example, you look at the really, really major ones like PetroChina, for example. I mean, these are agencies that employ millions of people within China. So, I mean, any indication, again, that there's restrictions on the use of iPhones in China is, I think, very severe.
So, Jill, South Korean chipmaker SK Hynix also says it's now investigating how its semiconductor components have been used in Huawei's latest mobile phone. What can you tell us about that? It's a crazy story.
It really is, yeah. I mean, look, I think that, there's obviously a lot of attention paid to Huawei right now. Bloomberg had a chance to tear down this Mate 60 phone that Huawei is using. Huawei is putting out. This is, again, Chinese tech, one-time giant that was really a driver of 5G tech, really making a lot of cutting-edge technology. And, U.S. sanctions employed in 2019 certainly seem to cripple a lot of its capabilities. Now what we're seeing, though, is that it's capable of building a phone with really high-end technology contained within it, with 5G capabilities that are akin to, the latest Apple iPhone. And at this point, I think that, you're looking at, I think, how exactly they're able to do these kinds of things, how they're able to circumvent U.S. sanctions, if that's indeed what they did. It's certainly, I think, an interesting story to continue watching to see how it develops.
Yeah, it's pretty incredible. Jill, as always, thank you so much for all of the insight. Jill Dice is there for us in Hong Kong. Now let's also bring in Plurimi Wealth Chief Investment Officer Patrick Armstrong. Patrick, there's so much I need to ask you, but let's start with Apple. I mean, does this give us an indication of what China's trying to do, or does it put in question valuation for Apple and other technology stocks?
I think it does both of those things. This is an opening salvo potentially from China. Right now, what they've done is immaterial to Apple, but they're trying to build up some political capital to fight back against what the U.S. has done with chips, what the U.S. has done with Huawei. And if you make things more onerous on U.S. companies coming into China, then you have something you can trade with as well. So I suspect that's the thoughts from China. Apple's not a cheap company. I think it's multiple is warranted, given its cash flow generation, and it's not cheap, but it's below 30 times earnings again. So I think that's a level that I'm comfortable to own it at anyway.
So, Patrick, what does it mean? I mean, do you think they'll do more on some of the technology stocks, or if you're an American company with significant business in China, you're in a wait and see mode right now?
Yeah. So if I'm China, that's what I do. I try to build up as much so I can have a counterbalance against what the U.S. is doing to you, and then when you do get into negotiations, you can say, I'll give up this, I'll ease this, and then the U.S. can do a tit for tat and on the good side of things. So I suspect that's China's thought process. I suspect there's more to come. Markets reacting to it, not based on what's happened, but that this may be the opening of what's to come.
Patrick, the other story today, and it's interesting to put, so you have China on one side, and then you have what the Fed does, and we have a couple of speakers before that all-important decision, September 20th. What's the driver of these markets? I know you look specifically at companies, but is it still inflation and the Fed, or because we're nearing the end of the hikes, it doesn't really make that much of a difference?
The Fed's still important because if the Fed makes mistakes and hikes too much, that provokes the recession, and then you don't want to be long equities. So the Fed's not given us a clear signal that they're done with hikes. They're still on the fence with that. I think they're done. They've indicated to us that they're already in restrictive territory. You've got unemployment starting to tick up, still very low levels. You've got inflation on a downward trajectory. If I'm in the Fed, I'm comfortably sitting on my hands here and just letting that work its way through. But more hikes, I think, would be a policy mistake. That's a risk for equities. China growth is nowhere near what anyone hoped it would be at the beginning of the year, but it's still positive. It's probably going to continue to weaken next year. But growth adds demand. I think playing China through energy is the best way to do it, because every day there's more oil being consumed in Asia and more oil being consumed globally, and there's not much new production coming on.
So you don't see interest rates at 6.5%?
My view is they're done. I think they don't need to. I think it is restrictive territory already. You can see that from inflation and the tick up in unemployment, job openings coming down. The labor market was too tight. It's getting to a level where it's a bit tight, but I think the path is still getting into a pretty neutral labor market. So the Fed's, there is a lot of two-sided data where something beats and something misses, but I think that's indicative of a policy that's probably marginally restrictive, and I think they can just let that play out.
Is there anything, so you mentioned energy stocks, I know we'll talk about luxury. Is there anything at the moment that you're selling off?
The last thing we've sold was, we've been reducing some technology stocks. We're 3% underweight, so it's not a massive underweight. So we've reduced equities overall. Our balanced portfolios are at 46% equities versus a 50 neutral, so it's at the fringes. And it's not so much that I'm worried about equities. I'm attracted to the real yields on bonds, getting a 2% real yield on a treasury and an inflation-protected treasury, 2% above inflation that maybe does grind higher. It's because there is a compelling alternative to equities, not that equities are in a terrible valuation.
But I guess, how do you price, this tit-for-tat, U.S.-China kind of concerns that could be on trade, but that could quickly escalate into something else?
The worst-case scenarios is what everyone starts to price when these things happen, and then they're self-rectifying because no one wants the worst-case scenario. It's building up the capital to provoke the discussion and a path towards better growth. So I don't ignore it. I think it's probably something that is going to be ongoing, but you shouldn't be pricing for the worst-case scenario because both sides don't want that to happen.
You don't own? Do you own any of the banks in Europe?
In Europe, I own BBVA, so don't have big positions in banks, but I do own BBVA. I've got lots of bank debt, is where I'm playing banks for primarily.
So we're back to school. I feel like the next 12 months, I feel like all the traders also, they're getting their head around, some of the headwinds and what they need to navigate.
Yeah.
What's the hardest thing to do right now? Is it, be prepared for volatility when it comes? Or could we see a big unknown in terms of energy shock?
What we've got is a Goldilocks scenario in the United States. My base case is that you've got the soft landing somehow engineered in the United States, but you've got the opposite of Goldilocks in Europe, which is persistent inflation and weakening growth, and there's not much growth to begin with. So playing the discrepancies between Europe and the US, and China's another story. It is going to be very divergent macro scenes. It's not complete unison the way it was years ago, where everything was going on the same path. So I think that's going to create a lot of opportunities and risks.
What about the UK?
UK, I think, is like Europe. I think I like the growth outlook in the UK better than Europe right now for the first time in a long time. I think.
Why is that?
It's just Europe's got more issues right now with, if you look at the PMIs, the services, employment, it's more linked to Russia as well. If there's any pickup on oil and energy from Russia, if Europe puts more sanctions on them, which I expect probably has to happen, I think that's going to be a bigger knock-on on Europe. So it's not that I'm bullish on UK growth, but I think it's probably gotten to the point now where it's looking as good as Europe at least.
Okay, thank you so much, Patrick. Plurimi Wealth Chief Investment Officer there, Patrick Armstrong, stays with us. Coming up, we discuss the luxury goods stocks after more than $25 billion was wiped off from the sector's market value in just one day. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now still with us, Plurimi Chief Investment Officer Patrick Armstrong. Patrick, I know we've spoken about luxury in the past, and this is actually our big number today, the fact that so much was wiped off the luxury market when Richemont yesterday said that inflation was really starting to take a hit. I mean, we thought they were immune, right? What's this big number? $25 billion of market value lost in 24 hours in European luxury stocks.
Yeah, I think it's probably an overreaction. So I came into this year and that was my biggest theme, and we lightened it up in March just because they all went up 40% for us in the first 3 months, and it was a play on China reopening, disposable income, and pricing power, because input prices very small versus what they sell. And it still makes sense to me, that case. I don't see how input prices really impact Hermes, LVMH. Richemont highlighted it. But I think the US consumers also weakened on the high end versus expectations. China, even though China has been disappointing as a whole, the Chinese consumer has done what you would have hoped for, I think. So I haven't reinitiated going back overweight luxury, but it's something that I'll be looking at again now, because the multiples, again, make sense. LVMH, we bought it at 22 times earnings last September, sold it at 30 times in March, and it's back down. It's not back to 22, but it's mid-20s again, and I think it deserves a premium multiple, and input prices clearly are not irrelevant, but they're not going to be that material either.
And so you prefer an LVMH to a Kering or a Richemont?
Hermes is the one we own still,
yep.
And LVMH is the one we had and sold, and that's probably the one I would get back into. I think.
Why?
I like their multiple makes sense to me. They're the dominant player. They definitely have the pricing power across all segments. It's Hermes trades at the premium multiple. The leather goods is really strong. But yeah, before I buy it, I'll compare and contrast them. They're much of a muchness, but LVMH, the dominant position there, I think is the one that my bias would be to.
I like that, much of a muchness.
Yes.
What do you do with a lot of retail stocks that are maybe in the squeeze middle? So not the discounters.
Yeah, so I don't own any of them. I own Amazon, which is a retailer, obviously, which is taking market share from everyone else. And we don't have a single retailing stock in the portfolio other than that, actually.
They look cheap.
They look cheap, and for good reason. I think you do want to have pricing power. I don't think you want to be exposed to disposable income so much going forward. Unemployment's starting to tick up. I think we are in a soft landing in the US, but in Europe it is going to be continued tight purse strings, I think. So it's they don't look cheap enough for me yet.
Yeah. Patrick, I don't know how much time you spend not looking at technology per se, but actually cybersecurity, because when you speak to a lot of chief executives, apart from foreign affairs, something happening in Taiwan, they always point to cybersecurity.
Yeah, and the companies haven't been really guiding higher. Like Fortinet really missed. They had a number of large contracts that were deferred, and it's questionable whether they come back in. So the big picture makes sense, but somehow from the bottom up, it's not translating into massive revenue growth yet. So I don't see why not. I'm surprised it hasn't. But yeah, the bottom-up company-specific guidance isn't showing the strong growth that you'd expect.
Is there something else that maybe related to Japan? I mean, this is the big unknown, right, in the next 8 months, and what they do with yield curve control. I know I ask you every time.
Yeah.
But is there a way of playing that?
Well, I'm short Japanese bonds, and I don't have a short yen on. If they keep the yield curve control, you've got to short the yen. I think they're going to continue to loosen it gradually, and it's just too big of a differential versus where the US is, where the UK is in terms of interest rates. You can't, it's just going to be a funding carry trade, and they have to get rid of that. I don't know what the limit is, but they own more than half of bonds outstanding already. That just creates a natural limit there. So short Japanese bonds makes good sense to me.
Patrick, I know I spend quite a lot of time thinking about why the market is discounting, or at least ignoring what's happening in Ukraine, between Russia and Ukraine. Is there something that needs to happen for the market to price it in, or is it just a almost unmeasurable risk?
I think it's discounting things. It's definitely it's very hard to do. I think the next impact for markets will be more and tighter and realistic sanctions that are actually imposed on energy from Europe, because you can't be importing oil and gas from Russia given what's going on. I think that's the move, that there will be political pressure and political will to actually enforce in the coming quarters.
But I guess what we saw in some of the soft commodities, or commodities in general, that's played out largely, or are you still expecting some tectonic shifts?
I think owning soft commodities makes a lot of sense for a lot of reasons. You've got Russia, Ukraine, you've got climate change, you've got droughts, you've got flooding, you've got population growth, higher incomes per capita. All of that translates into more meat consumption, which is very grain intensive. So it's not that people are eating more grains, but as you move from grain-based diet to meat-based diets, 25 kilograms of grain to get 1 kilogram of edible beef. So you've got a multiplier effect. So all of those things lead to, I think, soft commodities spiking higher on moments where there is an exogenous shock, and drifting higher over the long term. So I think it's a play that makes sense in the long term.
All right, Patrick, as always, thank you so much for joining us. Patrick Armstrong there, Plurimi Wealth Chief Investment Officer. Now, coming up, embracing technology to ensure democracy, legitimacy, and resilience. Bloomberg Original speaks to the Estonian Prime Minister about harnessing the transformative power of technology. That interview is next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the big story today is, of course, China seeking to broaden its iPhone ban to state firm and agencies. And you can see pre-market Apple down almost 2%. And Estonia's Prime Minister shares how governments can strengthen democracy, legitimacy, and resilience by embracing technology, all while facing an aggressive neighboring state. Well, Kaja Kallas spoke with Bloomberg Original's host and executive producer, Azim Azar.
What do you do as a forward-looking government in terms of addressing the risks of AI, the questions that need to be asked of it?
We see this on the European level, that we could use or diminish the administrative burden by using the AI.
So you see there's an efficiency opportunity.
Absolutely.
But there's still this problem of the idea of the black box, the idea that there's some creature that is making decisions about my life that I can't perhaps inspect.
We can't pretend that this is not coming, so we are ignoring this. No, we don't do that. But at the same time, we are very cautious of over-regulating, because if you start to regulate in a very early phase, then you focus on the incumbents, because this is what you know, and okay, this way it operates. But every time you focus on the incumbent, you actually make the rules that are made for the incumbent and not for everybody else.
Yes.
So the balance question is about the, how to not kill innovation, at the same time addressing the risks that there are. European Union is focusing, trying to get all the risks.
Right.
And I think that is not finding and striking the right balance.
Estonian Prime Minister Kaja Kallas there on our new show, Exponentially. Now, the other thing we're looking at, of course, is what's going on in markets. It's a big day for markets because of China and also some of the repricing on what traders are expecting the Fed to do for the worst performing sector in Europe. We have mining. We also look at some of the fresh stimulus commitments from China. That could probably not come at a better time, but doing little to boost some of the European stocks. In fact, stocks 600 basic resources been on the retreat for most of the year, down nearly 15% since then, and that's more than any other sector in Europe. Coming up, crumbling concrete and the cost of childcare, a deep dive on the trouble facing the UK government as Parliament returns from its summer break. That's still ahead, and this is Bloomberg.